Hello, everyone, and welcome back to the Saigal Seatrade podcast, your deep dive into the world of maritime trade and shipping markets. I am Research Analyst Shruti, your host for today, and we are in for a fascinating conversation today about the current state of the global shipping market. We'll be exploring everything from VLCC trends to product tankers and even the evolving LPG landscape. Joining me today is shipping and commodity expert Mr. Sandesh Ghandat. Sandesh, welcome back.
Thank you, Shruti. It's great to be here. I am looking forward to our discussion today about what's happening across the shipping sectors.
Alright then, without further ado, let's start with the VLCC market first, which has seen some interesting movements recently. And we have noticed rates climbing, particularly out of the Middle East Gulf and the West Africa region. What's been driving this bullish sentiment, Sandesh? And do you think these gains are sustainable?
Well, Shruti, that's a great question to kick things off. The VLCC market, it has indeed been fascinating to watch lately. If we look at what happened just last week, we saw a market that started quite subdued because of the Orthodox Easter holiday. And many charters were holding back on the progressing their May programs. And that initially created a bit of lull. But what's interesting is that despite this quiet start, there was this undercurrent of firmness in the market. What we are seeing is really a textbook case of supply and demand dynamics at work. So we have the tonnage list that's available ships in the region. It has been tightening significantly. Now why is that happening? Several factors are at play. We have had some vessels being absorbed for storage place, and others they have been kind of a repositioning to different basins, whether they expect better returns. And we are also seeing the effects of the longer voyage times due to ships avoiding the Red Sea. Now as the week progressed last week, the market transformed dramatically. We have Chinese charterers, they kind of began finalizing their positions, which always has a significant impact given the volumes they move. We started seeing a sporadic inquiries re-emerge, and by midweek there was a genuine excitement among ship owners as they anticipated additional early May cargo entering in the market. Now, having said that, the numbers they tell the story quite clearly. We have two VLCC benchmark, TD2 and TD3C. Their rates increased by 22.46% and 10.98% week on week. And when they increased, they kind of settled at world scale around 73.94 and 72.58 respectively. So what this statistic says that this is a substantial jump in just 1 week. That's it. We have another benchmark that is TD15, which is Africa to China route. It also increased by 8.7% and again settled at 69.63. So if we look at the TD22, which is a transatlantic route, we saw a 4.12% increase from 8.1 million to 8.4 million within a week, and that is a lump sum amount. Now, when we saw these statistics very carefully, what's particularly telling is that by the end of the week, we had world scale 75 plus levels coming into view. And that's significant because just a few weeks ago, the rates struggled to break above just world scale 60 mark. And not just Chinese but Indian also played in the market. Indian PSUs, specifically those are the public sector undertakings, they quoted 3 cargoes last week for VLCC I'm talking about. With the last one is done for Middle East to West Coast India, it got covered at world scale 95, and that's a solid rate. And it shows the strength we are seeing particularly for the regional voyages. Now looking ahead, the sustainability of these gains really hinges on the one particular key factor. And that factor is whether chartering activity maintain its current pace. If we continue to see a steady demand, specifically from the major players like Chinese and Indian charterers, these gains, they could not only hold, but potentially even push higher. So the tonnage list, it remains relatively high for early May loadings. But however, this is important for following this market closely. Any slowdown in activity could quickly shift the balance. So charterers are not passive players. They are constantly looking for opportunities to regain negotiating leverage. So if inquiry levels taper off, we could see them trying to test the owners, and by testing means they resolve by holding back and creating the perception of the reduced demand. Now another one of the factor that has been somewhat kind of overlooked but may become increasingly important is the repositioning of the ballasters. So they are empty ships moving into their next loading area. So depend on where owners decide to position their vessels in anticipation of future demand, we could see further tightening or even loosening of the supply situation in the key loading regions, because this kind of decisions, they are just basis on the where the market is forming in the next loadable areas. So what's fascinating me is most about the current VLCC market is how interconnected the various regions have become. The strength in Middle East Gulf weekly translate to firmer sentiments in the West Africa and even often the US Gulf as well. So it's truly a global chess game with the ship owners and charterers constantly adjusting their strategies based on what's happening across multiple basins.
Well, thank you, Sandesh, for that comprehensive overview of the VLCC market. Now, let's talk about the Suezmax and Aframax segments. In the Suezmax segment, which seems to be facing different dynamics in different regions, we have seen relatively modest gains in the West Africa region compared to more subdued performance in the Middle East region. What's behind this regional divergence, Sandesh? And do you see the Suezmax market evolving in the coming weeks?
Well, the Suezmax market is indeed presenting us with an interesting study in the regional contrast right now. And I'm talking about this specific week, last week. It's a kind of a perfect example of how shipping markets, they are rarely monolithic. And rarely monolithic means what happens in one loading region quite different from another, and even the same level and same vessel class. If we start with the West Africa market, which has been the relatively bright spot for Suezmax owners, we saw a market that began last week on a firm note with rates kind of a gradually edging upward. And then the fundamental driver here has been tight tonnage availability in the Atlantic basin. So TD20, which was again the benchmark for this particular class, which is a key for West Africa to UK continental, because European demand is now getting kind of offset with respect to West African crude oil cargoes. So it increased by 6.72% week on week and got settled around world scale 119.17, just below 120. So that's kind of a decent improvement, though it is not as dramatic as we observed in the VLCC segment. So what's interesting about the West Africa Suezmax market is how it weathered the Orthodox Easter holiday. We saw a brief pause in the activity, but the underlying fundamentals, they kind of remain steady. And when the traders and suppliers, they came back post holiday, freight levels held firm as an increase in cargo activity was again balanced by a modest replenishment in the available tonnage. So that's about the Suezmax market. Let me also focus on Aframax market. So Aframax segment has indeed been taking a different path compared to the larger tanker vessels, because it's been a more subdued market overall, but with some nuanced regional variation that are kind of worth exploring. Now starting with the Middle East Gulf Aframax market, last week began very, very quietly. Primarily, it was due to the Orthodox Easter holiday again and the long weekend in the Western Hemisphere. We saw very minimal activity with virtually no new fixtures reported during the early part of the week. And this lack of action means what? The rates, they kind of remain relatively steady, essentially continuing the pressure that has been built up from the previous week. As the week progressed, however, we began to see a slight upward trend emerge in the rates. This wasn't driven so much by a surge in cargo inquiries, but rather by tightening supply of modern tonnage in the region. And what's interesting in here is the owners' behavior we have observed. There was a clear preference among the ship owners for repositioning vessels westward rather than the eastward. They preferred to position their vessel west of Suez than the east of Suez. So this strategic positioning choice actually supported the upward momentum in rates because it effectively removed some tonnage from the immediate MEG market.
Thank you, Sandesh, for giving your insights on the crude market. Now let's shift our focus to the clean tanker segment. We have seen some notable movements in the LR and MR tanker rates. What's driving these changes, and how do you see Indian Petroleum Product demand influencing the market going forward?
So you know what, Shruti, you have touched one of the most dynamic segment of the shipping market right now. Clean petroleum product tanker sector has been on a quiet journey these past weeks, and there is a lot to unpack here. Now let me start with the LR1. So these are the long range one tankers. So we saw remarkably strengthening last week, and freight rates on their benchmark AG Japan route, which we track as TC5, it surged by 17.19 world scale points to reach world scale 147.19, and that's a significant weekly gain by any measure. In dollar terms, or when we talk about the time charter equivalent earnings, it was around 21,963 per day, just slightly below than 22,000 per day, which is up by close to $4,000 per day, or we can say that around 15.21% week on week, if we want to contribute precisely in terms of statistical terms. What's driving this? That should be your question, Shruti, because we are seeing a perfect storm of tightening vessel availability coupled with steady demand out of Arabian Gulf. We have refineries in the Middle East. They have been running at high utilization rates and producing a substantial volume of middle distillates and naphtha that need to find homes in the East, particularly in Japan, Korea and China. Then coming on to LR2 segment, these are long range two tankers, not as dramatic as the LR1s, but AG Japan freight rates on the TC1 routes, they increased by 8.89 world scale points to reach 0.11 mark week on week, and their earnings pushed higher to $26,481 per day, and it represents around 9.2% growth week over week. So what particularly interesting in this shifting dynamics between these two vessel classes, currently the LR2 premium over LR1 for AG Far East voyage has surpassed world scale 20 points. This has encouraged, and not just encouraged, but from time to time charterers, they prefer to upsize their cargoes when there is a premium increasing. They find it better economic of scale because larger ships despite higher nominal freight rates. We have seen more than 15 LR2s right now available for loading out AG West Coast India region. These are specifically for the second decade of May 2025. And that suggests that while the market is firm, it's not yet reaching the tight conditions. We saw the same tight condition during some of the peaks last year. So the immediate focus for the market participant is clearing a handful of outstanding LR2 cargoes first. And several of those cargoes, they expected to continue into the next 2 weeks. And eventually it could delay the tightening of supply that owners are hoping for ahead of Japan's Golden Week holidays. So historically we often see a surge in activity before this holiday period as charters secured coverage. Now let's move on to MR tankers, and these are medium range vessels. So on the Sikka Japan route, again this benchmark TC12, it was also gained by 6.03 world scale point, and it was closed around 146.41 world scale points week on week. However, the earnings recovery was more restrained compared to the larger ship classes because the TC was around 1206 per day, and the growth is just merely 5.66%, very very modest, and the improvement suggests that the rising competition amongst owner even as cargo volume shows some seasonal support. Now talking about the Indian product demand, to address your question, I have to say that this is absolutely crucial to understanding the regional product tanker market. So March 2025 data, it shows a significant strengthening in the India's product demand. And when I'm saying product demand, it is domestic demand that driven particularly by gasoline. We have motor spirit, its consumption surged by 11% month on month to 3.51 million metric tons. And with the high speed diesel, they kind of also rebounded to 10% month-on-month growth at 8.08 million metric tons. So these increases were supported by the rising mobility trends, mostly fueled by industrial activity and then the household travel as we head into the summer season. Then we have a ATF, it also increased by 9%, and then the LPG also increased by 6%. So there is overall growth amongst the product market domestically rising. And even we saw domestic naphtha, it also increased in consumption by 14% month on month. Now looking forward, India's demand patterns are kind of a particularly fascinating. So just to give you some stats here, we have IMF report that unveiled last week, and according to the IMF's World Economic Outlook from April 2025, India's economy is projected to grow by 6.2% in 2025, and we can have another significant growth in 2026 where the growth forecast is surpassed from 2025's numbers, and that growth will be a 6.3% in 2026. These things or these stats, they kind of are given clear suggestion or clear solution, and they kind of maintaining a clear lead over the global and regional peers. So the strong economic performance is kind of underpinning petroleum product demand growth. And what's especially interesting in this particular divergence between diesel and gasoline prospect, diesel demand remains robust, and it was mostly supported by an extended economic cycle and minimal impact from EV adoption thus far. It's poised to significantly outpace gasoline in demand growth, and it kind of a benefiting from India's strong cycle of recovery. So diesel also has a more diversified demand base, because only about 62% of its consumption is linked to road transport, and making it less vulnerable to electrification of the other alternative fuels compared to gasoline, which is almost entirely 98% a road fuel. So over the long term, gasoline may face great structural headwinds from improvement in the fuel efficiency and then the electrification. As light vehicles, they kind of are easier to convert to electrify rather than these heavy duty diesel vehicles. So having said that, the supply fundamentals for gasoline are also set to weaken as emerging Asia leads to a surge in the global capacity additions. So with regional growth alone outpacing twice the rate of the global gasoline demand in 2025. So all of those factors, they have significant implication for product tanker demand. Now you have asked me about India's role. So let me tell about India's role. India's role as both major consumer and exporter of refined product means these demand trends directly impact shipping patterns. So the growth in the diesel demand, for instance, could lead to increased imports into specific regions, or potentially higher exports from the Indian refiners to make like Europe, where the structural diesel is a kind of a shortage. And when I am saying increased imports, don't confuse with the imports from other nations. Here I am specifically talking about the coastal movement, because we have one of the largest refinery in the west coast of India, which sometimes supposed to cater the market in the east coast of India when there is a shortage of material. So having said that, the potential for increased exports from India, specifically to the EU due to compliant fuel requirements, it could strengthen the certain trade routes that may benefit mostly MR tankers and kind of a marginal support to LR1 tankers as well. So this is something market participants will be watching closely in the coming months.
Well, thank you, Sandesh, for that detailed breakdown of the clean tanker market segment. Now let's move on to the LPG market. We have seen some interesting divergence between east and west of Suez. So what's happening in these markets right now, and how do the seasonal factors and terminal capacity constraints factor into the current landscape?
Well, the LPG shipping market is indeed presenting us with a fascinating study in contrast between the east and west of Suez. So this sector often operates with its own distinct dynamics, somewhat independently from the oil tanker markets that we have been discussing. And the current situation really highlights those differences. So starting with the east of Suez LPG freight market, we wrapped up what could best be described as a relatively quiet week. We have seen activity limited with only few fixtures reported. The laycan will be for first half of May, and this will be Arabian Gulf loadings. So rates held steady around $50 per metric ton basis Ras Tanura to Chiba. Again, they have benchmark route. So it represents around 6% weekly decline So we have seen LPG market declining last week. So while we have seen some easing from the recent peaks, we are still at relatively elevated levels from a slightly longer term perspective. So the market overall has felt more stable recently, but the forward outlook has taken on slightly bearish tone. So what's particularly interesting about the current East of Suez situation is the potential scenario we might see if demand doesn't pick up after the weekend. We have seen some vessels could be forced to make difficult choices, either accept idling, which means, sitting without employment and earning nothing while still incurring operating cost, or, even sometimes consider ballasting to west to find employment in the Atlantic basin. So neither option is particularly attractive now from an owner's perspective, but they may become necessary if the cargo opportunities remain scarce. So to answer your second question, ship supply developments, they kind of influence the market's direction in the coming months. So LPG carriers order book, it kind of represents a significant percentage of the existing fleet, which could create pressure on rates as these vessels delivered over the next 12 to 24 months. And the other important point is geopolitical factors. It continue to affect LPG shipping as well, particularly the ongoing situation in the Red Sea and then the tariff war and all sort of different things. Many LPG carriers have been avoiding the Suez Canal route and opting instead for longer journey around the Cape of Good Hope. So while both east and west of Suez LPG markets, they are currently experiencing relatively subdued conditions, they are positioned at different points in their respective cycles with the terminal constraint and arbitrage economics and seasonal factors. They all are playing important roles in the shaping the near-term outlook. So the potential for vessels to reposition between basins in the search for better opportunities highlights the global nature of this particular market and the strategic decisions owner must make in ballasting their fleets.
Well, Sandesh, this has been an absolutely fascinating and comprehensive journey through the global shipping markets, and your insights on everything from VLCCs to product tankers to LPG carriers have given our listeners a masterclass in maritime trade dynamics. Thank you so much for sharing your expertise and analysis with us today.
Shruti, it's been my pleasure. The shipping industry is truly a window into the global economy, and I am passionate about helping people understand these markets that are so vital to world trade. I hope our listeners, they have found our discussion valuable.
I'm very certain they have. And to all our listeners, do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay tuned.